Hi, everybody. This is Michelle, and I'm here with Mark Sorensen, the founder and CEO of Royal Fund Management and 401k Maneuver. So, Mark, a lot of people, a lot of investors have questions about rebalancing their 401k. And I know that there are some 401ks that automatically rebalance for investors, right? Just take a little bit. Let's just start here. What are the advantages and disadvantages to that? And maybe actually, why don't we back it up? What is rebalancing?
Oh, okay. Yeah, let's
Let's
start
do
with
that.
let's start with the basics.
Okay.
Well, yeah, some 401ks offer automatic rebalancing, and basically rebalancing just simply means that when you first invest in your 401k, let's say you decide to be 50% bonds and 50% stocks.
Mm-hmm.
Okay. Well, as the over time that gets skewed. So, for example, typically stocks over time are going to outperform bonds anyway because bonds are more conservative. So let's say 5 years later or 10 years later, all of a sudden because the stock market has done a lot better, you're now 75% stocks and 25% bonds.
Mm-hmm.
Your original intention was to be 50-50. So what rebalancing does, whether it's quarterly or annually, it just readjusts those percentages. So if you were 50-50 and now suddenly the market's done really well, so you're 60% equities, stocks, and you're 40% bonds, it's time to sell some equities and buy some more bonds to bring you back to 50-50. What is the advantage of doing that? Well, if you started out 50-50 and you never rebalanced for a lot of years, let's say, and the market did a lot better than the stock market did a lot better than the bond market, then years down the road, you have much more exposure to stocks than
Right.
you do bonds, which are more conservative. So you might suddenly be taking a lot more risk than you originally intended to take, which therefore could create a disaster just before retirement if we had a bad market downturn just before retirement. So the advantage of rebalancing is to always bring you back to the allocation between stocks and bonds, as an example,
Mm-hmm.
that you originally intended. I would argue, though, that there might be a better idea than just automatically rebalancing back to the initial percentages of ownership.
Okay. What is it? Tell us
Oh,
more.
okay, okay.
Please tell us more.
Let's look at something that I think is kind of interesting. If you're rebalancing back to original percentages, and we'll go back to that 50-50, and now the stock market's done so much better than the bond market that you're now 75% stocks and 25% bonds. When you're selling what's gone up and buying more of what's underperformed, I might would argue simply that you're selling what's working and buying more of what's
Right. Well,
not.
it's not, right?
So that's kind of interesting. So I think there's another form of rebalancing that might make more sense. And that is, rather than rebalancing to just reallocate back to your original allocations in terms of percentage ownership of certain asset classes, whether it's bonds or stocks or international versus domestic or large cap versus small cap stocks or what have you, why not take a look at what's working every 90 days? So, for
Mm-hmm.
example, if the market's roaring and the trend is positive, why would you want to have 50% of your money in bonds anyway? Why
Right.
not take advantage of the market when it's doing well? If it looks like things are ugly, like 2007, 8, and 2009, I guess the bottom of the market was March, if I remember right, 9th of 2009, I think was the actual bottom. Um, if if you were ahead of that and didn't have as much money in the market and had more in bonds, you'd have weathered that storm better.
Mm-hmm.
So instead of just reallocating back to percentages of a specific allocation that you start with, my argument would be take a look at your account every quarter. Let's take a look at the current market and economic trends. Let's
Mm-hmm.
decide how much should be allocated to stocks and how much should be allocated to bonds in our example, based on the current market conditions, so we can take advantage of the good times if they're
Right.
good. And then for whatever equity exposure we have, I like to say, let's try to be in what's working and out of what's not. In
Right.
other words, just because you're in the stock market doesn't mean that the international markets aren't doing better than the American or domestic markets. Doesn't mean that small cap stocks aren't doing better than large cap stocks. So we try to look at where the momentum is quarter by
Right.
quarter to try to improve performance. So
So
allocating back to original percentages can make sense. It can avoid you when things get askew from taking more
sure.
risk than maybe you might be think you're taking at a point in time. But I would argue rather than selling what's working and buying what more of what's not, why
Hmm.
not take a full look at the investment menu that you have and decide first on risk management and second on where is the momentum, and let's try to take advantage of that quarter by quarter.
Yeah, so this surfing analogy just comes to mind. We were talking about taking advantage of what's going on in the market. Look at every quarter, see what's going on. It's like, don't just catch any wave. Wait for the, you can ride a wave you can ride a wave for a while rather than, oh, let's just take this wave because it's here, or this is what I'm supposed to do, or what has been advised, right? Like what I think I'm supposed to do. So is that correct? So like you're looking at it quarterly. It doesn't mean you necessarily have to rebalance, does it?
No,
It's
and
just that
I
you're
like
evaluating to see what's going on. And, if the market's good, why not have more allocated to stocks? Maybe if it's right for you. Is that what I'm hearing you say?
yes, and I love your analogy of riding a wave. When I'm not a surfer, but I assume there's some placid times where you're just laying on your board and
Yeah,
then
you're sitting out there. Yeah.
and you get up and you take advantage of it, jump up on the board and take advantage of that wave. Well, it is similar. I would argue that in your 401k, you know, to be conservative is one thing, to be moderately aggressive or somebody else might be aggressive.
Hmm.
I would argue, why not be aggressive and ride the wave when the indicators are good and the market's doing good, and then be more conservative
When things aren't so good.
when the wave is gone.
Right.
So, in fact, I might would argue that if you're rebalancing your account in that way, even someone that's 60 years old and only 5 years from retirement, wouldn't they want to be aggressive when the market's obviously doing well? And as
Yeah.
long as you take a look at it every quarter and get out of the way of the train when necessary, and then be more aggressive when all trends are positive, I would argue that you don't have to just be overall conservative, moderate, or aggressive. Imagine that in the last decade or so that the market's done extremely well. You were conservative, really conservative, so you had 80% of your money in bonds and 20% in the stock market.
Hmm.
Well, you missed a big wave.
Yeah,
So
absolutely. You did.
as long as why not be aggressive when the signals are pointing that direction, and then be conservative
When it's not.
when deemed necessary, and that's why being engaged with your 401k, I think rebalancing is key.
Hmm.
But the old school rebalancing of just bringing things back to your original allocation percentages, to me, makes less sense than rebalancing every quarter to manage risk when necessary, but ride the wave when times are good.
Right. And this is what 401k maneuver does for investors, correct? This is
Well, yes,
exactly what they do.
yes, 401k Maneuver is a participant account management program, which means we can help an individual employee, no matter where their 401k is, by taking a look every quarter, reviewing their account every quarter. We do a lot of research. We determine whether we want to ride the wave, whether the trend
Hmm.
is good. There's an old saying in the market, don't fight the tape. The trend is your friend. Don't fight the
Right.
Fed. I could bring all these old
All
cliches,
of them.
but we're going to take a look at the market and economic trends quarter by quarter, and if all signals are positive, why not be allocated that way rather
Right.
than just percentage allocations? And then when we deem necessary, if the signals aren't good, then why not get out of the way of the train for a little while? Imagine that if you were more conservatively positioned during 2007, 8, 9, and then when the signals were positive again,
Everything started going
got
up.
more aggressive and
Right.
rode the wave the last 10 years, how much further you'd be ahead. So there's no guarantees. We're people. We are real people managing 401k accounts on behalf of employees. But it's what we do every day. And, there is a lot of research out there that we could probably reference, Michelle, that talks about that if you hire professional management, you're likely to average as much as 3% more a year. And that can add up to a lot of extra money to support one's retirement, for sure.
Absolutely. And if anyone's interested in seeing what that 3% looks like, on 401kmaneuver.com, we have the calculator option, the 401 calculator tab. So go check that out and play with it. And it does the math for you. And it shows you that you don't think 3% is a big deal. And then you start, I mean, you're right, compounded interest, and you add 3%, 3%, 3%, 3%. And it becomes a lot of money quickly.
Right. Michelle, let me just add that, there has been an evolution of 401k advice. And it kind of started with buy and hold, meaning that you decide what you want your 401k money to go into, and then it just stays there. From there, it kind of went to, maybe we ought to rebalance back to original percentages about once a quarter. And then the industry created target date funds. Why not just put you on a glide path to retirement? We'll be more aggressive when you're younger and get more conservative when you're older.
Right.
That still is kind of a buy and hold approach, though, right?
Yes, it is.
And then there is professional management alternatives out there that still kind of look at just age and an expected retirement date. What I think we do a little different at 401k Maneuver is we're going to look at, in fact, we call it personalized professional account management advice, where we're going to take a look at your individual risk tolerance, but then every quarter, rather than just rebalance like to original percentages like we talked about, we're going to rebalance based on current and market and economic conditions, try to ride the waves and get out of the way of the storms to the best of our ability.
Fantastic. Thank you for that. Is there anything else you want to add before we wrap this up?
Yeah, Michelle, let me just add one thing, though. When you're on our website, since you alluded to that, you will find or get offered a 15-minute 401k strategy session. Don't be afraid to do that. Our advisors will answer your questions and determine whether we think we could help you or not. And we are passionate about educating people and helping them to engage with their 401k so that they have a chance of retiring with their dreams, so to speak.
Right. Awesome. All right. Well, thanks again, Mark. Appreciate it.
Thanks,
and
Michelle.
thank you everyone for watching. Bye-bye.